Hello, good morning, and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thanks, as always, for joining me. You know, I've been telling you the markets were going to power higher and gave you a variety of reasons. And boy, this morning, I can only got one thing. That didn't take long, did it? The S&P 500 has just tapped another fresh record high above 6,300 points. Now, naturally, the doom and gloom squad is already out in force, warning about some sort of tariff-driven inflation reckoning ahead. I'm also seeing, not for nothing, a fresh round of clickbait casting fear, uncertainty, and doubt. FUD. Take those things with a big grain of salt. I beg you. Record highs are not cause for panic, despite what a lot of people think. In fact, they're a sign that the markets are doing what they're supposed to be doing, which is pricing in future profit potential. Now, you wouldn't be alone if you're tempted to fall for the schlock, right? Lots of people do. Don't. Just remember two things. Number one, the market's real drivers are super simple, and they always will be. Strong earnings, great management, productivity gains, and profits that are capable of powering the path higher for decades. Not days, not hours, not minutes, decades. And number two, FUD always sells, but rarely pays. Remember, the biggest risk isn't a correction. It's that you're not on board as the market charges higher over time. So, get on board, dang it. It's that simple. Here's my playbook. Number one, Jamie Dimon, CEO of JPM, does it again, and he turns in a spectacular earnings report. Now, I told you yesterday that I expected strong numbers and that my estimates of 43 to 44 billion and 4.50 per share were slightly above consensus. I was entirely too conservative. Jamie Dimon reported Q2 earnings obliterating estimates. Reported revenue was 45.68 billion compared to 44.06 billion expected. EPS came in at 5.24 per share compared to 4.48 expected. Net interest income NII was 23.3 billion, up 2% year over year, and fixed income trading and investment banking outperformed. Now, CEO Jamie Dimon is one of the smartest guys in the room, literally smartest guys on the street. I think he's probably the best CEO, or one of the best CEOs on the planet right now. He noted very positive information, positive inputs from U.S. tax reform and deregulation, but he also warned of persistent risks that we've been talking about: tariffs, trade uncertainty, geopolitical tensions, elevated asset pricing. I would expect nothing less from Dimon. JPM is a perfect, textbook perfect case of why I insist on buying the best and ignoring the rest, aka other banks. So here's an investing tip in this department. The world's best investors tend to have very concentrated portfolios because they're playing to win. So take a page out of their playbook or be content with falling behind. Number two, Nvidia's green light. What exactly did Uncle Jensen tell President Trump? Here's why this is important. Nvidia just got the green light to restart its H20 GPU sales to China. Now, the same chips that got blocked by U.S. export controls in April are suddenly back in play after a quiet meeting between Nvidia's CEO Jensen Huang and U.S. President Donald Trump last week. Now, what did Uncle Jensen tell the president? My guess is that it'd be stupid to cut China off because doing so will give the Red Dragon added incentive to build its own versions and innovate faster. Now, if this doesn't make sense, think about it. We've seen this playbook before. It was the same with oil when the U.S. repudiated Chinese sole source contracts after Gulf War and suddenly learned to diversify suppliers. Then again, when Russia invaded Ukraine and Beijing got pinched by Western-controlled financial systems that led it to accelerate yuan-based oil and gas trade. Anything that China deems a critical resource, it will learn quickly to diversify its suppliers, and it usually learns at the wrong end of the stick. Now, I told investors to buy point blank Nvidia and other key names into and off of April's lows because the markets would come to terms with what's happening sooner than you'd think. Now, hopefully you did. Nvidia has returned 68.05% since then, while the S&P 500 has returned 23.83% over the same time frame. Today's move resets the entire competitive landscape, folks. And again, it's not unexpected, at least if you've been reading my work or have attended any of my presentations around the world in the past 12 months. Again, I cannot say this strongly enough. Hopefully you are playing offense. Why? Because there are 10 to 15 NVIDIA-like developments in the wings right now. And in my humble opinion, a handful of companies that are going to come charging out of the blocks several of which are already in the not for nothing in the OBA model portfolio and well into the green as I record this. And of course, I'll be here and you can find me at one bar ahead if that's of interest. If not, awesome. No offense taken. Get to the investing part of this. Number 3, Baidu just ate Waymo's lunch. I have repeatedly warned investors that the dragon was coming to dinner. The only decision you need to make, I said, was whether you wanted to be at the table or on the menu. Here is yet another example of what I'm talking about. Baidu has announced that it's partnered with Uber to deploy Apollo Go autonomous vehicles outside the US and mainland China. Basically, everywhere but the US, where regulators have their heads, well, let's just say, in an unmentionable part of their body. This is serious trouble for Whimo, but not for Tesla, which has been playing to counter this eventuality for years, in case you're wondering. Trade idea in this one? Interesting. Long Baidu, but simultaneously short Uber, which seems to have the short end of the stick in this deal. Now, you already know what I think of Whimo, but that's private, so it's moot. Number 4, Target is the next Kmart. Now, don't say I didn't warn you about this one either. Target shares are down 60% from their peak. Store traffic's falling. Sales have stagnated for 4 years. And that is not a blip on the radar, folks. That is a brand in serious trouble. Target used to be edgy, vibrant, the kind of place where shoppers left with 3 times what they came in for. Now, Target is a sea of generic. Empty shelves, disengaged staff, messy stores are the new normal. Not for nothing, but even diehard fans are walking away. Contrary to what scores of pundits are going to tell you, the deeper issue isn't inflation or even inventory management. Target lost its edge trying to be everything to everyone, pulling back from DEI, chasing margins, and letting the once strong culture slip through the cracks. Now, the current CEO is on the way out, and they're scrambling to course correct with price cuts, rebrands, and what they're calling the Enterprise Acceleration Office. Now, this reminds me very much of Kmart's fall from grace. It was the beginning of the end when people started referring to it as came apart, as in whatever you bought there came apart, which was pronounced exactly as it looks in a very derogatory take on a once proud brand. Retail is won on 3 things: relevance, clarity, and conviction. Oh, and execution, not nostalgia. Target can do whatever it wants. My guess is, sadly, it's gone with inside 5 years. Keith's investing tip: when a company forgets what made it special, customers do not wait around. What they do is go where the experience is better, faster, and feels right. So repeat after me. Money is like water, and it will flow to where it's treated best. Meanwhile, my favorite retailer, by comparison, to really drive my point home, has returned 104.44% over the past 3.8 years, while Target shares have dropped 60% since they peaked. And by the way, my favorite retailer's also got great divvies, which is why, of course, OBAers who know what that is tell me they're thrilled to own it. All right, number 5 today, MP Materials and Apple have tied up. This is getting better by the minute, right? First the DoD and now Apple. 2 of the most powerful institutions in the world are placing their trust in MP Materials. Should you buy shares? That's the question on a lot of people's minds. Well, it's a tough call, honestly. It's never a smart move in my book to chase prices. MP shares have now jumped 103.46% over the past 5 days since the DoD announced its deal, and they're up another 5.43% today alone. This is outrageous. But the bigger and more interesting and potentially more profitable bet in my mind is to identify other deals in other industries where strategic investment becomes likely but is not yet recognized. For example, semiconductors, SMRs, small nuclear reactors, battery and energy storage specifically, AI, biotech, genomics for bioresilience, space tech, food supply, including synthetic biology, agro-robotics, and CRISPR applications for more efficient crops and less fertilizer. It's big. Anyway, I'm going to be looking carefully, and we'll be talking about it for months, but meanwhile, you should take a look carefully too. Today's bottom line: skipping a workout feels harmless until it becomes a habit. And the same is true with slacking off on your investments. Success doesn't care about excuses. You got this, I promise. As always, let's make it a great day. Thanks for joining me once again, and I will see you tomorrow.